Have you just opened your brokerage account with a financial institution and now you're wondering where to invest? Well, I'm here to tell you about what I did. Let's unpack all of that in this episode. Now let's get to it. Hi, welcome back to another episode of Finance with N. My name is Niranjan and I'm here to tell you about my journey to financial freedom with passive income. Today, I'm here to unbox and unpack for you what I did when I started investing, and perhaps what I should do if I had to redo it again. When I started investing in 2007, I was looking at all the cool companies around the world. I was looking at some of the tech companies. I was looking at some of the companies in tourism, travel, and I thought that some companies that looked nice from the outside were very good businesses to invest in. How wrong I was on a lot of those things. I reached a stage in my life where I said I cannot guess which companies are doing well, which companies are doing badly. I kept trying to beat the market and I realized sometimes I did, but during other periods I didn't. In a study done in 2024 by S&P or Standard & Poor's, it was revealed that up to 88% of the mutual funds in the US did not beat the market. What does that mean? That means if you, as an individual investor, just invested in the market, you would do better than 88% of all the mutual funds available to invest in. Now, the other thing with mutual funds is they have very high expense ratios, or higher expense ratios than, let's say, investing directly in the market with an ETF. So basically investing in the market isn't too bad because there are only 12% of funds that are doing better. And over a period of time, if you keep looking year after year after year, that number may even be going down. Now, when we say investing in the market, what does that mean? Typically in the US, that means investing in the S&P 500. The S&P 500 is a compilation of 503 of the largest publicly listed companies in the US. Yes, I know, it's not 500, it's 503. Let's get back to the point. Now, if you invest in these 503 companies, you're basically getting exposure to 80% roughly of the total market cap in the US. That's not pretty bad, isn't it? By investing in one single fund, you're getting exposure to pretty much a majority of the US market. Now, the S&P 500 historically has returned roughly 10% each year. Sure, there are some years that do better, there are some years that do worse. But I'm going to give you a tip at the end of the video on how you could perhaps even do better than this average return by just investing in the S&P 500. So please continue watching. The other good thing about the S&P 500 is if you invest in the S&P 500, you also can get a dividend each year, and that dividend is also growing. Now you may ask, how does one invest in it? I started to do some research, and there are exchange-traded funds, or ETFs, through which you can invest in the S&P 500. Depending upon where you're living, where you're a tax resident, there are different funds available to you. If you're living in Europe, I'll tell you what you can do later, so you can please forward through the video. If you're living in other parts of the world, or let's say most other parts of the world, there are a few criteria that you can use to invest in ETFs. The first one is the size of the fund. Now, ideally, I'd like to invest in a large fund because you have more liquidity when you're buying and when you're selling. Another criteria, of course, is the expense ratio. I typically like a low expense ratio, so less than 0.1% of the money that I'm investing should go towards the management of the fund. Another criteria is do you want to accumulate the dividends, or do you want, that is, the dividends get reinvested in the fund, or do you want the dividends paid out to you? I typically like the dividends paid out to me because it psychologically helps me, and I think if one is a new investor, it's always good that you get dividends, and it motivates you to keep investing in the fund. Now, which are the funds in the US that are good? This is not financial advice, but the funds I like are the SPY or SPY, or the VOO, the VOO. The SPY has a low expense ratio of 0.09%, while the VOO is even lower at 0.03%. That means that you'll spend about 30 cents a year on the fund management on a $1,000 investment. That's pretty good. Now, if you're living in Europe, things get a bit more complex, thanks to a few individuals who thought they were being very smart. Just kidding. In Europe, we have what are called UCITS funds. And unfortunately, if you're living in Europe, you're not allowed to invest in the funds that some of our friends across the pond are allowed to invest in. But that doesn't matter. Now, what must one keep in mind while investing in UCITS ETFs that track the S&P 500? Well, the first criteria, of course, is the size of the fund, because one wants liquidity, one wants the ability to be able to buy and to sell. So I'm typically looking for a fund that's larger than $10 billion or 10 billion euros in size. The other one, of course, is the expense ratio. I want that expense ratio to be less than 0.1%. Another criteria, how is the fund actually compiled or put together? There are different types of funds. One is called a physical fund, which is the exact replication of it. Another one is a synthetic fund or a swap fund. For investors who are starting, who want to keep risk low, it's good to go with a physical replication of the S&P 500, so the exact replication. Another important factor is the age of the fund. Now, unfortunately, thanks to these smart gentlemen, a lot of these funds are not very old, because UCITS and the regulations that came into implementation for all of this only started in 2018, while a lot of S&P 500 funds in the US have been in existence for several decades. The fund that I like is the VUSA, which is run by Vanguard. Why do I like the VUSA? Because it ticks all the boxes. It has a low expense ratio of 0.07%. It is one of the largest UCITS S&P 500 ETFs. It is a physical replication, and it pays out a dividend every quarter. The important thing, though, with the UCITS ETFs is the fact that they may not be necessarily in dollars. They may be in British pounds, they may be in Swiss francs, they may be in euros. So there is currency fluctuation that will impact the rate of return as well in the end. Now, I told you at the beginning of the video that I would give you a tip on how one can even do better than 10% return. A lot of us get scared when the market goes down.
Between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. In time has fallen about 18%. The stock market is now down 21%.
Obviously brutal.
Reality has set in that we are still very much in the middle of a trade war.
Now, 10% is the average rate of return the S&P 500 has given over several decades. However, if the market goes down and you are lucky enough to invest when the market goes down, you may actually have a better return or a higher return than 10%. So as Warren Buffett says, when others are greedy, be fearful, and when others are fearful, be greedy. So when the market goes down, and if the only thing you're investing in is the S&P 500, invest more when the market goes down. You may actually have a higher rate of return than 10% on average. I hope this video was useful. This is one of the things that I use in my investment strategy, the S&P 500, investing the S&P 500. I'm not saying put all of your money there. I would recommend that you talk to a financial advisor once again. But I do believe that investing in the S&P 500 is one of the best ways to start investing, to grow one's money, so that one has a bright financial future. Thanks, and look forward to seeing you again. Bye.